And good evening. This is the Eye of the Storm podcast for the S&P 500, the NASDAQ 100, and the treasuries, the 30-year bond, the 10-year, 5-year, and 2-year notes, and the precious metals, gold and silver, and the US dollar index. Beginning here with the SPX, or just the two equity indexes that I follow. The markets continue to go through what really appears to be more of a consolidating period of time. And even though the counts are very clear and we still sit in between getting a stronger leg down within this intermediate third wave, which is now in progress, again, starting on the weekly chart in the SPX, I'm continuing to count a primary degree C wave down, which will in turn, once it's complete, will complete also the cycle wave A. So I am looking that towards wherever this is going to end up, it is going to be completing a larger pattern, which will give us the opportunity, give the markets the opportunity to actually put in a more sustained bounce or a counter trend rally that should pick up steam and go pretty easily. Now, again, timing is going to be everything, but I think for the balance of the year and into the start of the new year, we should continue to see some downside. We should continue to see some stronger downside as we reach that low for cycle wave A. So back to the primary wave C, which is in progress. Inside of primary C, there are going to be 5 waves of intermediate degree, of which thus far we have completed in both the SPX and the NDX intermediate waves 1 and 2, which puts us into the intermediate third wave. Within that intermediate third wave, we have 5 waves of minor degree, of which I do believe we've finished minor wave 1, and I'll go down in with the chart so we can look at it more closely, that we're finished with wave 1 and that we're likely in minor wave 2. But what I want to go over first is here I have the much larger degree, right? So even on that super cycle, when we're looking at where this super cycle wave 4 should complete, ultimately we are looking at the fourth wave of 1 lesser degree, which just happens to be cycle degree, and that low happens to be, we're going to call it 700. So it's actually 667 to 700, or somewhere within the price range of cycle wave 4, which bottomed in 2009. So we're not going back all that far. So in essence, again, I'm just going to reflect what we're truly correcting is the excess, the extreme excess of capital that got pushed into the system by the government, by the Treasury Department, in order to rescue our own economy and then to rescue and to prop up us, the retail side of that equation. First, we got the corporate side, right? Companies, the major problems on that financial collapse we saw in 2008, 2009 with real estate and then banking, et cetera, really taking a good punch along with a lot of corporates. So they got bailed out. Then we had to put more money into them so they could keep the people working and they could get back online. They could get the product back out there. They could get back to work. And that carried us all the way up to the pandemic. And then we got the pandemic, which basically just really rocked our world because we were told we couldn't go out. We couldn't go to work. We couldn't go to where there were lots of people. We had to figure this out. Well, we put on masks, then we social distanced, and then we did all of these different things, and then came the vaccine. But in the meantime, the shock of being shut down economically was quite a shock to the markets. And they all took a nosedive, major nosedive, in the form of a primary fourth wave. And then from that primary fourth wave, that's where we, retail, had to be bailed out. We weren't allowed to go. A lot of people lost their jobs if you're in a service industry or anything where you had to actually physically go and your job was in an office or in a restaurant or in a movie theater or in many other areas that depended on people being there to service. If you're in the service industry, boom, you were out without a job. and really trying to wonder how you're going to try to make ends meet. So unemployment kicked in, and then we had to have special types of unemployment. Then we had to have stimulus checks because everything was just so getting crazy. All right, so that first round was, I believe, about $8 trillion. Then we got that total. Then we've got from 2020 up to our highs, and even now more, we had 13 trillion. Yeah, I believe. Yes, 13. In any case, it's a lot of money. It's a great deal of money. And that's what's been swirling around and being pushed into the markets and being pushed into areas. And now we have inflation. It's just a byproduct of what we've done. It's a byproduct. You inject all this capital, whether you needed it or not, you got some. And then the markets took off because they also fed corporate some so they could continue to pay people. So we got a lot of stuff. Plus the interest rates were less than 1% on the 2-year, on the 5-year, on the 10-year. The 30-year got down to 1.17% interest. That's pretty incredible. Now, these all are inflationary things. It cannot last forever. This was vertical move. We're now correcting, if anything, we are correcting the cycle wave 5. But doing that, it's actually also correcting a super cycle on a super cycle degree on a move that began in 1932 up to 2022. So it's pretty amazing that we're correcting 90 years, but we're also correcting 13 years. And those are all fitting. Now, so what I've done is I put it in the retracements for fourth wave. It's correcting the third wave. Huge, but still correcting that third wave. Follow Elliott. And then I'm correcting also, and more importantly, I think what we're initially doing and going to be doing for a while is correcting this. So whether this all gets taken back, no, not yet. But I think we will be coming down a lot more as we correct this. Now, back to that that weekly chart. So we're in the process of the beginning stages. Now, using the retracements that we should follow as we retrace back, where on this cycle degree, we're likely are going to come back down and test the price range of that previous fourth wave of one lesser degree. That's this primary fourth wave. I feel very strongly we're going to end up in there. And I feel very strongly that once this intermediate third wave kicks into gear, we're going to automatically end up inside that price territory. So then we'll be able to start piecing together where we think this cycle wave A is going to complete, produce this cycle B wave. And remember, we still got a C wave, and that C wave will be down. And it's going to be a lot harder than the A wave was. So because the C wave in and of itself will be 5 waves, not like this A wave, which is turning into an ABC. It's going to be a C wave, which is 5 waves in and of itself. So it's going to go down harder and stay that way all the way. This, you could feel the battle. Still, they want to battle it. But eventually, I think we get down there, we put in this B wave, and then we'll be looking for a major, major collapse. And similar, you can go back in time to see when these things happen. And it's going to be a surprise. It's going to be something that's going to really knock the jaw right out of sync or right out of its socket to force it to just drop the way that I think that C wave will have the potential in doing. If you're still learning Elliott, remember, when we're looking at a C wave, which we are now, they can be very destructive. And I keep talking about that because even on this degree, destructive would be a move down to 3,000. We're sitting at 3,800, above 3,800. We're going to drop another 800, 900 points just to put in an A wave or the finish of a C wave? Yeah, we are. and then rally and then drop again with the potential to go further than this, then we may, again, I don't know what the situation is going to look like, but if I had to put out what the potential is, I'm not saying this is what's going to happen, but according to Elliott and according to what I can put together on the fibs, we are looking at levels below 2000 right here and right here. And they could be real. And guess what? This one is within the price territory of that cycle 4. Ultimately, that's where the C wave could end up. But it's, again, back to the price level of really adjusting and getting that, all that excess money has got to be taken away, has got to be forgiven. You know, it's just like repaying this is just not going to happen. So somewhere along the line, we got to see adjustments. Now, back to just the SPX. Where can we look at? What can we see for coming for year end? I think we're going to continue to get kind of what we're doing right now. We're going to get the days where everybody's buying it because it's rotating out of into another, or again, guess what? Next Friday, the last expiration of the year. Hallelujah. So how do they want to finish this all up and send out 2022? I really believe that it's just going to be that the facts are going to take over, and the reality will press people to say, I want to be out. I want to be out to start the new year, or I want to shift out of this and put it over here. So we're going to see the migration, the rotations, I believe, continue, whether that's going to be in precious metals, whether that's going to be in getting out of high tech stocks and going into more mid cap stocks, or going into stocks that are a little bit more solid with a forward guidance. A lot of that type of stuff is what's going to be going on. What's going to happen in the bonds? Well, the bonds are going to continue because we already know from the Fed, inflation's not under control. So we are going to continue to look for higher rates. So the yields are going to be higher. The bond prices will be lower. And so while that whole process unwinds, which I'm going to go over once we get to the treasuries, our equity market, everything needs to go in and coincide. They're all being affected by the exact same thing. Going back to the top of my pecking order, interest rates sit up at the top. What happens to interest rates filters down through all the rest. So interest rates filters down to the bonds, filters down to the currency, filters down to the corporate, and last on the list, but not the least, are us, the retail, the person sitting outside that circle, the person that isn't, part of a humongous, too big to fail bank that has these positions, but they got their own worries. So do we. Now, what can happen here? I do believe we're going to continue to see the market go down, but it's maybe not going to go as fast. We may get a pleasant, just kind of an inside bouncing around week and if we start to break down, it could go quick. And from right here where we are, if I'm looking at, I'm going to bring it down. Let's look at the daily, right? So we got 1, 2, 3, 4, 5. Minor wave 1, minor wave 2. You got to go more. I can bring it down even to the hourly chart, and we're looking like, see, it did. But what are we looking for? Well, actually, we're looking for 38.50. That's the SPX. The EX closed at 38.68 because it still has premium because it's a March contract. But in the cash, we'd be looking for here. In the cash, I also can put on additional. If we're still going to bounce around in this minor wave 2, which we may, but we've already reached 618, 38.41, 618. We're hugging it right now. We finished the week hugging it, let's say. But then we have 38.52. That's right where that 50 sits. Is that going to do it? Very possibly. A, B, C, boom, done, down. But if it does drop into the third, I'm expecting it to move pretty quickly. And I would look for it to be breaking 37.64. Again, basis the cash, 37.64 on the way down as it continues to unfold. Now I'm going to drop this guy, because we're now looking at, again, if we just took it to that small third wave that we're looking for, if this is -1, -2, I'm looking for that minor third, let's just take a peek at that. Oh, this is -1, and this would be -2. -2 actually should come up above. Could come all the way up. So I would go from here down to here. And just because I'm only going to go to that 250 period moving average. So 38.55-ish, okay? What could that third look like? We should quickly get ourselves down below. Again, I said 37.64 and start heading towards 37.25 down to 3,700. Now we got a little bit of a cluster around 36.85. Okay, we're looking for the minor third. And that, I would think, is going to outdo minor wave 1 of 3. So 3,500 is the area I'm going to be looking for this minor third. And if it goes up higher still, then yes, these numbers will adjust accordingly. But that's my initial. But I think that eventually we could get down in terms of the intermediate 3. We're in the minor 3. We get it down, maybe down to here. We do a -4, -5. To finish this, we're down around 3,300 or lower. My next cluster is around 3,200. Now, that would just be maybe the intermediate third wave. Then we have an intermediate fifth wave, and then an intermediate fourth wave and intermediate fifth wave to finish primary wave C. Back out to the daily. Primary wave C, then, I'm going to take these off and remove that drawing. Now, primary wave C, we're going to go back out to here. And yep. And we're going to add this drawing. And we're going to take it down to the bottom of wave A. Come on. It's being fussy. Add my drawing, come on. There, down to here, up to there. All right, so primary wave C now has support to complete 3146, but I really believe we are now going to be coming down just to finish primary wave C. We're going to come below 3,000 and below. I have 2980 down to 2965. I'm going to call it down in there. That I think is appropriate. 3,000 should definitively be, give us some support. It's a big round number. Sort of like 4,000, 3,000, same thing. It's a larger round number because it's round all the way out. So down to this level, and then possibly we will be completing primary wave C, or we're just going to be completing down into here. Intermediate wave 3, intermediate wave 4, intermediate wave 5. We still have additional levels, but now we're looking at 24. That puts us really inside. I'm going to go out again. Remember, what am I looking for? I'm looking for this, into this zone. Well, the bottom of that is 2192-ish, 2190. So coming down to 24 in terms of the primary C wave sets the stage for that gigantic cycle wave A to complete, and then cycle wave B to begin. And a lot of ground to cover because they will be screaming, no all-time highs, we're moving up, we're going. There'll be, the pundits are going to grab a hold of that one. But I want us to be a little bit forward thinking and be more prepared. Because once we get to the low, don't try to get in front of this moving or falling knife or moving train or whatever you want to call it, because it really could destroy you. Understand that when it reaches its low and it's going to turn, we'll know. Because again, what we're looking for is that kind of like that V bottom or something to shift the narrative, to shift it from it's doom and gloom and the end is near to who we're surviving, and here's something to hold on to, positive, that sends the market going in the other direction. And we'll know it because we're going to get that bottom. We're going to get that V bottom. It's not going to sit around, mumble around, go, should we go here or there? It'll be quick because of the size of the low, the size of the degree that it's ending, and the size of the degree that it should be beginning will give us, hopefully, that V bottom. That's when you start positioning for upside moves. Because again, timing is going to be everything. It's not going to shoot up like a rocket and just go straight back up here in a week or two or a month or two. It's going to take the rest of the year, wherever we end up in 2023 to getting down here. The rest of 2023 and probably 2024 will bring us back up into here. And then again, something major is going to happen because it's going to drive it down in that next cycle C wave down. A lot yet to come. But going into January, I'm looking for continued downside. I'm looking for the market to come down and finish primary wave C and finish inside of that intermediate wave 3. So I am looking for some stronger downside to finish this year and to begin next, getting us down into these levels where we could start to look at the end or the completion point for primary wave C, and in addition, cycle wave A. Over in the NDX is pretty much the same. Okay. So we have pretty much everything in line and being the same. We have looking for the primary C wave to continue, right? Again, remember, I don't have, the NASDAQ did not exist in 1932. So we don't have that luxury, but I'm running these counts the same in terms of the degree. So to me, I'm just placing that super cycle wave 3 because I think that's going to be the depth. I think we are in a cycle degree corrective phase. And that means I'm doing an ABC down on a cycle degree. And again, just slipping over to our monthly max, the cycle fourth wave for the NASDAQ actually bottomed in 2002. Not in 2009. This is the financial meltdown that and how it affected here in the NASDAQ. The NASDAQ crashed in 2000 to 2002 and what was called the dot-com bust. What they want to call it after this is all done, who knows? But that was a pretty severe, that was 87% of its value in 2 years. So I'm thinking under Elliott, what we're really got to track out, and that's what I'm retracing on, is all of cycle wave 5, which is why I did the same thing in the SPX. Because these two are so tied at the hip because of the weighting of these stocks in the common stocks, particularly the big boys, Apple, Amazon, AMD, AMAT, Google, Meta, Moderna, Microsoft, etc. All of these big boys that are tech driven, that continue to be in favor because everything is technologically advancing. And all of that needs to be fed back out to the world because we're all using it. So these things will continue to survive. Right now, we're going through, there's way too much money. There's way too much money in circulation that should not be in circulation. We spend way too much money that we'll never get back. It's just not going to come back. So those are the adjustments that need to be made. Now, so on the NASDAQ, back down to that weekly chart, we have, these are the larger, again, the entire cycle wave 5. These are for those corrections. Well, we've already reached, drifted below, and now we're coming back down to the 0.382. And that is of the rally from the bottom in 2002 to 2022. So again, we're correcting 20 years of advance. And a lot of stuff happened in between. Again, I'm looking for this initial wave cycle wave A to complete in the price territory of the primary fourth wave, which is right here. So we have coming off, we're in a primary C wave, which consists of 5 waves of intermediate degree, intermediate 1 and 2 complete. We're in intermediate wave 3, of which, let's go down to the daily chart. I've done minor 1. We're still in minor 2, and boy, it's not finding a lot of legs to do much against what we did to get it down there. So NDX sitting right at its hourly 20. We can come up. There it is, the hourly 50 at 11,120. But if I put in just, you take a look at, the retracements for minor wave 2. There's the minor wave 1. So now we're looking at minor wave 2. Bare bones, 11,111, 11,313, 11,477. Wave 2s? Yeah, you could get all the way up there. I'm not looking for that. We have too many outstanding pushing narrative negative. But that's the reality as well, by the way. So, but maybe we can get back to 11,111. But see, we're just kind of running out of steam here. And wedging, a rising wedge, which kind of like tells me, okay, could it? Yep, one big fail up there and then bob, boom. So they could do that and then go bob, boom. Or they're just going to get up here real quick and still go bob, boom. And do a nasty drop. Because if it just is more looking that way. Now, what do we have coming off? Well, we've got that 10,676. And guess what? We drop into a little bit of a black hole. But if I take this out, right, remove that, bring this back to the daily chart, we can put on, well, let's take a look at what we think we can get for this minor wave 2. So we can go from, I'm going to go here, here. I'm going to go from here, here to, and it happens to be, it has to be 13, and this is 167. I'm going to put it there. And it just didn't come out right, but I'll perfect it. So this is the NDX. And it made its high here. We're in the other, it made its high here. So where we have, we see where intermediate wave 3 would be equal to intermediate wave 1 at 8,798. All right, so I'm going to go back down to the hourly chart so that we can kind of see. All right. First, let me edit that. And let me just forget it. Forget it. I'm going to activate. Nope. Activate. Push it. Come on. Put it right there. Okay. So it evens it out a little bit. Now let's take a look coming down. Right. Intermediate wave 3 equal to, here we got it again, right there at that 50, we got 100%. That's just under 9,000. It's 88 down to 87, approximately. That would be where intermediate wave 3 would be equal to intermediate wave 1. I'd be looking for a little bit more. Still looking for like 8,000, maybe 75. Seriously, this is what I think is going to hit the market. What's it going to take to get down there? Where will Tesla have to be? Why is Tesla dropping? Why will Micron drop? Why will Microsoft drop? What about all this good stuff that we're hearing? What's really going to go on? Adjustments. adjustments to what the outlooks are going to be. Does it mean that Microsoft's going to go out of business? Not at all. Does it mean Apple's going to go out of business? Not at all. But Apple's got to make its own adjustments. Don't forget, they got to come in with iPhone 14, like this is going to save not only them, but everything else. And that's what we were led to believe. And there were fair sales of iPhone 14. So the company is making money. But now we have to think about, we got production costs. We got the cost of keeping Apple's doors open globally. We have the same thing in Microsoft. We have the same thing in Metaverse. We have the same thing across the board. They're already laying off people because they need to, because they can't afford to pay them, because money is shrinking, not expanding, et cetera, et cetera. Adjustments will be made. Again, it's not saying that the world is going to come to an end. It definitely is not. Adjustments are being made. And we, sitting at the bottom of that ladder and that pecking order, we also are going to be making our adjustments. How you choose to do it is going to be like, don't be investing in a long stock now because they're telling you, well, you're in it for the long haul. We have to survive the long haul. So you're going to have to play it a little bit differently. If your choice is to hold on, then understand that you're going to go and lose before you ever make it back. Think about it. Now, so those are our levels that we have. Eventually, going back out to that weekly chart, I'm looking for primary wave C, which now I'm going to put on, and I'm going to take the intermediate waves off. And now I'm going to put on primary wave C. So I'm going to start up here. It's a different computer, and I'm getting used to the mouse. So I apologize as I fiddle around pushing what I thought's the right side of the mouse. Okay, so we're going to go there. Mother. Okay, so I'm thinking I'm putting my marker on, and I'm not, so please bear with me. I appreciate that. And we'll go there. And that's only the retracements. Okay, so let's try this again. I'm going to remove that, and I'm putting the others on, and it's not taking it. There, now I got it. All right. And then up to there. All right, so for primary wave C, actually, 100%, primary C would be equal to primary A. That's 8,031, going to come in bigger. What we have the potential is getting down to 1236, 6914, 67. That's all in that area of March of 2020 low. The daily, let me go back to my weekly, to that low, sitting right there staring us in the face. And that's where I think all this can come down to. Then we finish primary wave C, cycle wave A, and we rally. And then we come down again. And that's when I think we have a chance. Again, I'm not going to go out there and pretend to know exactly what the economic conditions are going to be, or what's going to trigger, or what's going to be going on. But I'm telling you that what my interpretation of Elliott Wave and my knowledge, and having used it for as many years as I have, this is normally what happens. The wave count and everything is in alignment for this particular move. What's going to trigger it? Well, we'll wait and see. But it is, since it's going to be pretty hard down, I'm going to say it's not going to be pleasant. It's not going to be easy. That something will be happening that's going to create that scenario. Again, I don't know. But what we can start to plan on is for this additional downside to complete cycle wave A, play the cycle B wave rally, which I'm pretty sure we're going to get. And the penchant for everyone to just latch on to buying. Oh, that means we're okay. That means we're good. We're okay. Everything's going to survive. We're good. We're good. We're good. And they jump back in. That only goes so far, but still, it's the human emotional response that's measured by Elliott. So what's going to be behind that human emotion response? We're trained that the only thing you do when you invest is you're investing for the long term because the market just continues to go up. There's no downside. All downside, that's just brief. That's just momentary. And so you're in for the long haul, stay, hold course. Well, okay, you can do that. Or you can just play each move. So I'm still looking for the end of the year. We got a week left, right? So I'm not wondering, it's like, okay, we may still see some downside. If we finish off this small minor wave 2, then the downside should pick up, and it should pick up speed, and that maybe that's how we end the year, or on its way, and then we begin 2023 by that continuation. But we will have two-way play, but right now we're dropping in an intermediate third wave, consists of 5 waves of minor degree. We're working on completing minor wave 2, which is the counter trend rally part. So after that, big drop. So yes, we have the potential where we could go from current levels and we could rally back up to 11,400, 11,300, and possibly even a little bit higher. Now that all could happen if we get into this move like Santa came and decided to stay the week. All right. All right. Over in the treasuries are also just continuing in their current states. Again, starting here on the weekly, this is the 30-year bond. Let me go to that monthly max because that's where I have everything written down. So what we can see here is I'm going to activate that and pull it down just a little bit. There we go. All right. So again, reviewing the 30-year bond at that high in 1981, the yields were 14.49% in the 30-year. On April 20th of 2020, they were 1.17. That's wrong. I think that's got to be. Yeah, it is. April of 20, because the bonds went up that high. It was 1.17. Then December the 1st. So a little bit over 2 years, 3.64, the 16th, 3.54, and last Friday, 3.73. So even though everybody wants to hang on, it's like, well, the Fed only raised, 50 basis points. Hey, come on, they might continue that. Here's the market telling you different. In a week, we jumped 25 basis points. So, or thereabouts. Now, what we're doing inside this market, I'm going to drop back down to that weekly inside the interest rates, is we are also correcting. Now, we did 5 waves down from the highs of 2020 down to the lows of 2022. Thus far, 5 waves down. Bond price, 5 waves down. 3 waves up is up next. Okay, so 1A, B, so or 1, 2, 3, 4, 5. This is the A wave. We're in a B wave. What can we do to kind of put some parameters around that? Well, let's take a peek. What I can do is I go over here and I switch this to retracement, and I go from there to there. So what can I do in terms of a B wave? If this is A of an ABC and we're now in the B, well, we've already come down. Okay, minimum 3.73. I'm thinking we're going to drop down to 4. Where's 4? Down here. Maybe a little bit lower. But it could come all the way back down to 117. It would be an ABC flat, but I don't think so because this in and of itself was a 5 wave. So it should be a zigzag, right? When you learn Elliott, 2 basic forms for a counter trend or a corrective move. Zigzag, which is A equals 5 waves, B is 3 waves, the C wave is a C wave, is 5 waves. So this one, N, 2, 3, 4, 5, okay, I can put an A wave there. We're in the B wave, which is going to be A, B, C. So this to me, now we're coming down in the, what I believe would be the A wave, A of B, and we do a B of B, we do a C of B, I think we can get down to 124, 123. Maybe 121. This is the 30-year. But then we're going to rally again. And I think that's what also happens next year. Maybe after the, somewhere in mid first quarter, end of the first quarter, we begin to put in our C wave up. So again, we're on this longer term chart. So these things takes longer to come through. Right now, I'm looking for a dip down to 4%, and then I'm looking for it to come back up to above 3.5%, maybe up as high as 3%, a yield. So remember, yields lower, bond price higher. Yields higher, bond price lower. They always move opposite. Okay, so 3.73 to end. How's it want to end the year? I think it's going to really want to end it around 4%. Then we rally again. Then we drop again, right? We had an A, a B, we rally in a C wave, it'll be 5 waves. That's your resistance. First of all, we have resistance here at 138. We have resistance at 135, 138, 145. That's an outlier. So for him to get up here to that 200 or here, those are outlier levels. This could be realistic, right? And since I got that, I can do a B wave, but I don't have the bottom of the B wave yet, so I can't really project a C wave out. We have our B wave projections, but now we need to see it complete, start to rally again, and then we'll be able to put in where we think that'll go. That's the 30-year. Let's take a look at the 10. 10-year, basically same deal. I'm going to go out. I put that on my max chart so we can see. Same deal. Well, 3.5 was a target that really wanted to get for December expiration, and it succeeded. Last Friday's expiration was 3.48. That's as close as to 3.50 as you want to get. So it ran it there for 2 weeks. Right? Then we started to drop, and we dropped 25 basis points. 12. On Friday, we were as high as 3.75. That was the close. Where the prices closed on Friday, the yield was 3.75. I think we can get to 4 here as well. So again, 30 and the 10, they're hovering between 3.5 and 4. So you could always think about it this way. You're going to sell 3.5 and you're going to buy 4. Figure out how you're going to do that and make money, right? That's the yield. But if you're selling 3.5, you're selling the 10-year note at where it's equal to 3.5. That's 115. Where is that 4%? Oh, probably 113, 112. Oh, okay. So you can make your money. Now, again, A, B, C. We have 116. We have 121. I think 121 can be realistic next year at some point. As it finishes its ABC counter trend rally, we will do another 5 waves down. Over in the 5-year, it's the same picture. Okay. 5-year Treasury yield in August of 2020, 0.23%. 5 years. 5 years, lock it in. How long do you want to hold that bond? You've been decimated if you bought it up there. For that, and then you're going to see it drop. All right, so August of 1981, 16.31 on a 5-year Treasury note. Now, coming up to December the 1st of this year, 3.68. December the 9th, 3.75. December the 16th, 3.61. As close as 3.5 as you can get on a 5-year. December the 23rd, 3.79. Going back up. Bond prices are being reflective. So, if the bond price is lower, rates are higher. So 3.79, 3.4 has got to be probably down in here. And you can run yourself some little fibs to give you where you think that's going to happen. We're just going to go right up to there. So you've got, yeah, it was above 107 and you got 107. So 107-ish in that hood is where I think we get 4%, probably even as high as 108, just below. But we should get down to 4%, maybe even a little bit higher in terms of yield before we get that C wave up. Last but not least, our pal, the 2-year. That's where we're seeing the biggest climbs in the rate in this past week are the short end of the curve. The 2-year note in April of 2021 reached 0.17%. Oh, God. We're still topped. We're topping above 4%. We got up to 4.33 on the 9th. On the 16th, we're at 4.17. On the 23rd, we're back at 4.24. So that would have been actually down here a little bit more. But I stuck it there by accident. And here is wherever the close was on the 23rd, wherever this weekly close on the monthly close isn't done yet. Let me go back down to that weekly close, because that's going to be where this guy did. So the weekly close was at 102.262, and that was 4.79. So, okay, I'm looking for the same thing there, except this ABC done, maybe, or ABCA, then we get an ABCB, and then we get a 5-wave C. So 103 still a strong target for the C wave, but probably not much more. And moving over, gold continues to puzzle me. Gold has the patience of Job, as they say, because here we're in a market that I believe should really be rallying a lot stronger than it is. But if we consider it's the pecking order, interest rates, bonds, currency, and we have the battle between the dollar and the yen, the dollar and the pound, the dollar and the euro. So our biggest competitor in terms of market is going to be European markets and the Eurozone. And so when the euro is being hit, or the dollar is rallying, or the dollar is falling, they tend to take it out on gold. So what the reality is that we're on hold. So for the last 3 weeks, we've kind of just bounced between 1835 topside and being held by a very flat weekly 50 EMA at 1781. So at 1775, we got the 8. So we have the support coming off, and it's holding it. It seems like we're just waiting for whatever's going to happen to boost this thing and do another one of these to get this wave going. Because eventually, in this 5th wave, I'm looking for it to break that 2092 and get itself up here to 2188 as a minimum. That's gold. But right now, we're stuck. We are stuck by stuck year end. So silver, it's the same story. Silver, I'm thinking, should even begin to really rally harder than gold. I think, but it's yet to even find its footing. Although it ended better, it's not finding its footing. And it's still kind of 3-wave-ish. A, B, C, 3-wave-ish. Don't like that. This is kind of weird. But hey, I still believe that silver will, he's come all the way over here, rally with gold. So it's yet to find its footing, but I'm still sitting more bullish on silver. And then lastly, we have the dollar index, DXY. And I'm going to go out to that monthly chart. And the reason is because I have this larger picture all measured out. I'm not putting up the code because I'm only counting 5 and in this color. So I don't really know, is this going to be a cycle? Is this going to be an intermediate? Is this going to be a primary? I don't know. But I think I think the highest I can count is cycle in the dollar, because there's so many different factors that to say that the dollar's on a longer term uptrend. Longer term, how long term? As long as we do for the market super cycle? No, I don't think so. But even if I'm counting an A, B, C, the A wave was 3. The B wave was 3. The C wave should be 5. But I'm not looking for a runaway, and it's an ugly pattern. All right. Because either way, if I'm counting this as a complete ABC, like this is A, this is B, this is C, that still has to be A. This still has to be B, and we're still looking for it. There's no way that I can count an A and a B wave as complete, and this is because we still have much more to go. So I'm going to leave the count as is. The A wave, the B wave, 1, 2, 3. We got a 4 going. It is bigger. It continues to sit and hug that 104. It's been below, but it gets right back above it pretty quickly. Now, what in my estimation, if I'm just using Feb extensions, looking for the C waves compared to the A wave, I'm going to put it on from that low to that high to that low. 100% is 122. We've gotten as high almost to 78.6, which is effective in the currencies and some other markets. I don't use it in the equity markets or the bond markets for that matter either. But here it tends to fit. Now, the 4th wave should find support. I really don't want to see it. I could, but if it starts dropping down towards 102, this 4th wave is way too big. And I'm going to have to think of something much different, like maybe that really was all we're going to get this time out of the dollar, and this ABC would be complete. Strange pattern, but it could. Otherwise, I am looking for the rally to pick up. We got 106.49, 110, 112, 115, and then onward. I do think we could get above that high, maybe equal it. So I think, really 120 fits real cleanly in there, as does 115 all the way up there to it, but ultimately there. And that's going to do it. We've kind of covered all the bases. The dollar, the precious metals are stuck. The interest rates are just fluctuating as they correct within their corrections. The equity markets continuing to correct, finishing up some counter trend stuff. So again, what we can expect for next week, it's really going to be balanced out against a lot of year-end positioning, and that would be across the board. So just remember, keep your pecking order in line, and it helps me to keep things in line what I'm expecting each one of these markets. I look at the interest rates first. What's going on in the interest rates? Well, they're starting to creep higher again, simply because they're putting in a B wave. Regardless, they are moving higher again. So what is that going to do to the dollar? Well, the dollar should rally. Higher rates. I want dollars. I'm going to give it over there. I'm going to go put them in the bond. I'm going to go put them where I can get it because I'm getting a higher rate. How should that affect gold? Likely to bring it lower. But I think long term, we've got other things that are really affecting the dollar that should affect gold. And that is the digitalization of our world currencies. The yuan, the ruble, the rupee, the dollar, the Canadian dollar, the yen. Everyone's going digital with their currency. Again, the conversation goes as follows. What are you going to back it with? We've already seen the Ponzi scheme in Bitcoin, in digital currencies. Pretty disastrous. Pretty like, wow, how much money got just stripped out of people's hands. You think I'm going to go trade a digital dollar? What worth does it have? Well, to correct that, China, Russia, India, the United States, Canada, Europe's, all of them will back it with gold. So suddenly fiat currency's out the window. We better go with digital, but we better go and we got to back it with something. So that I see happening. But right now, sitting doing nothing. So I am looking for the dollar to begin to rally again. All right. I'm going to wish everybody a very, very, very happy holiday season. If you are anywhere east of Chicago, please stay safe. Please stay warm. Please, I urge you to take the utmost caution traveling. It is brutal out there from what I can see. And have a very Merry Christmas, Happy Holidays. And the next Eye of the Storm podcast will be on Christmas. Excuse me, Christmas. Hallelujah. It'll be on New Year's Eve. It'll be next Saturday. And the next Elliott Wave update will be on Monday, the 26th, once Globex reopens. Have a great holiday, everybody.